And let's try that again with my mic turned on. So hello, everybody. Happy Friday to you all. This is Mike Rixey. I am the lead options instructor for NetPicks. And this is our options trade recap for the week. Trying to turn some alerts off. We've got an active market here today. So a lot to cover here, a lot of good trading this week. You know, it's interesting. I'm taking full advantage of the flexibility that being an active trader presents. You know, with COVID, you know, hitting, a lot of us have been working from home, myself included. And now we're in the process of selling our house. So I am in a different location without my normal setup here today, which is great. I love the flexibility. I love being able to track markets. But of course, anytime that you're out of your normal element, your normal routine, your normal setup, the market decides to have a very active week, right? But so we'll take it. No complaints. I'd much rather trade in an active market. And that's exactly what we're seeing this week. You know, I got off the phone with a customer here earlier today, and they mentioned, you know, Mike, what's going on in this market? It's such an unusual market. Well, guys, if you just started trading within the last months, you got so programmed to seeing a one-way market to the upside every single day, every single week, right? We saw the market moving higher on a regular basis, making new all-time highs, even with all of the uncertainty with COVID. That is not the normal environment historically. What we're seeing this week is much more typical, where you have back and forth movement. You do have some fear and uncertainty being priced into the market. It's not always going to be that one way, buy the dip, play the market from the bull side every week. That's not the case. As an active trader, we want the back and forth movement. What we're seeing the last few weeks is really a much better environment long term. I know it doesn't feel like it if you're a newer trader. You're saying, wait a second, we're seeing these big moves back and forth. What I'm going to show you today is how you can utilize some of these strategies that we use on our side to benefit from a bullish, bearish, and neutral market. Having the flexibility there as a trader is absolutely crucial now more than ever. And I think this market is going to stay active through the rest of the year. We have all of the uncertainty now, not only with COVID remaining an unknown, but now with the election season really kicking into high gear, there's a lot of uncertainty there also. So I want to dive in. We'll talk about some of the technical patterns that we're seeing today. How do we navigate through some of the active markets that we've seen? I'll recap some of the trades that we've taken this week, and then I'll also walk you through some trades that we're looking at going into next week. I think there's some really nice opportunity in some areas going into next week. So let me go ahead and bring up my screen here. Give me a brief moment. And I'll turn my camera off as well, so it's a bigger screen. All right. So what you're looking at here on the screen, this is just a simple daily chart of SPY. I like to start out all of our sessions taking a look at the market big picture. I don't use this chart to trade off of. It's not what I'm using for my entry and exit points, but it's what I use to gauge overall bullish or bearish sentiment. Are there any key support and resistance areas that I need to be aware of? And it helps guide me on what types of trades I'm taking. Am I looking for more weekly or monthly options? Am I looking for more long calls, long puts, or vertical spreads? We have a lot of flexibility there. And I want to take advantage of that flexibility. I don't want to lock myself into just using the weeklies or just using the monthlies or just buying long calls, long puts. Having a mix of strategies makes a huge difference over time. It doesn't force yourself into a corner where you're really focused on one style of trading or one market. So just to have a look at this chart, I mean, you're looking at a handful of moving averages, just a mix of simple and exponential moving averages. And the key moving averages that came into play all week this week are the blue lines on the chart there. Those are the 89 and the 100 period exponential moving averages. We have been stuck on top of those levels pretty much all week. The key here is we have not closed below those levels. We have probed below them intraday, but every time we try to break them, those support levels hold and we rally back up off of the lows. We're seeing that yet again here today. Look at the low of the session today. Let me zoom in so it's easier to see. Look at the low of the session. It was right on top of that moving average, right on top of 322.83. That's been our line in the sand the last 3-4 days. That's going to be our line in the sand this afternoon and into early next week. Is that level going to hold or is it going to break? If it breaks on a closing basis, it could be a nice little move to the downside. There's a nice air pocket there between the current support level and the 200 period moving averages. Those are the red lines down below us between 310 and 313.25. That could certainly bring in some of the panic selling. The selling that we've had the last week or two, I know it has felt bad, but we haven't really seen a lot of panic selling. It's been very methodical movements to the downside. If we break this key support level, look out. I mean, it could get nasty in a hurry next week down to those 200 period moving averages. Now, on the flip side, let's say that those levels continue to hold and we continue to bounce back to the upside. The first area of resistance that I'm looking at is up at 328.51. That is the 8-period exponential moving average. That's the pink line on my chart. We also have a whole slew of moving averages above there between 331 and 337. I point those out because if this market does rally higher, there's a lot of key areas of resistance that we're going to have to get through. If those levels are going to break, we're going to need to see some broad-based buying. We're going to need to see some better volume than what we've seen on the upside here lately. And we haven't had any signs of this market just, all out rallying to the upside. Today, the rally is really due to tech. That's where the buying is at. It's just a handful of key tech stocks, right? You've got Apple up, Amazon, Facebook, Google. You've got a lot of those key tech names strong on the session, and that's all the market needs. That is offsetting some of the weakness that we're still seeing in the financials, and we're still seeing in energy. We talked about those two sectors last week in our video. We talked about those being weak and potentially due for bounces. We haven't seen that yet. Those sectors continue to remain very, very weak. And I think it's going to be difficult long-term for this market to break up through these key areas of resistance on the daily chart. It's going to be difficult for that to happen unless we start to get the financials and the energy names to pick it up. Now, speaking of the financial names, if I go over to my watch list on the left-hand side, next to the symbols, this is the Thinkorswim platform, by the way. It's what I use for my charting in a lot of cases. If you take a look, if I click on the red and blue icons there, you'll see a message pop up indicating that there's an upcoming earnings release. Citigroup, for example, has earnings out on October 13th. Bank of America has earnings out on October 14th. JP Morgan, earnings out on the 13th of October. The financial sector is going to go into earnings season here very, very quickly. I'm not opposed to trading the financial names right now. You just have to know that in all likelihood, if you're going to use a spread, a vertical spread, which we'll talk about in a moment, you're probably going to have to hold through the earnings number. And that's something that you've got to be comfortable with. For those of you that are not familiar with how stocks trade around earnings, there's a lot of uncertainty there. It can provide some pretty big moves in either direction, those overnight moves. And it's a higher risk, higher reward type of scenario when you get into earnings season. So we'll talk about that more in the weeks to come, because not only do we have the financials releasing earnings, we're going to pretty much have every individual stock on our watch list releasing earnings in the month of October. It's going to be a very active stretch, and we'll talk about that more in our midweek and weekly recap videos. So what is my outlook? What is my takeaway from this chart here going into next week? Until those support levels, they have held pretty much 5 days in a row on SPY. Until those levels break, I think you have to lean cautiously bullish here going into next week. What does that mean for me? For me, it means more vertical spreads. I've been looking at selling a lot of credit spreads here this week because the credit spreads give me 5 ways of making money on the positions. They're not going to have the home run profit potential, but they're going to give me a higher probability of success. They're going to be more forgiving type trades. I love to buy calls and puts in certain markets. Right now, it's not one of those markets, in my opinion. If you're looking to swing trade for a period of days or out to a few weeks, this type of a pattern, yes, we've seen some big moves intraday. We haven't seen a lot of follow through into day 2, 3, 4, 5. So I am really trying to take what the market's giving us. And for me, that's just using a lot of credit spreads. If we see this market break higher or lower around these support and resistance levels, then sure, that could shift our focus away from the credit spreads and more so to the long calls, long puts. So very committed to taking what the market is giving us. If I take a look at the internals here today, the volume ratio is actually negative on the NYSE. The NYSE is the New York Stock Exchange. It is very positive on the Nasdaq. So in the upper left-hand corner, these two boxes indicating that volume Definitely strong on the Nasdaq, not so much on the NYSE. This is not broad-based buying in every sector, every stock. How do I know that? Well, in the upper right-hand corner, we've got the advanced decline line. Right now on the Nasdaq, it's at plus 947. If this was a really strong trending day that we were going to see this thing explode higher with follow through, we'd see that number closer to plus 1500. It's positive right now, but not overwhelmingly so. And if I switch this from the Nasdaq to the New York Stock Exchange, you'll see there that the advanced decline line's only at plus 400. What that indicates to me is this is not across the board buying. There are pockets of strength, and the pockets of strength are in the key areas of this market, specifically the tech sector. That's really what the market needs to remain bullish here. As long as the Nasdaq stays strong, it can help overcome some of the weakness in the other areas. All right. I mean, you can see on this 5-minute chart, it's been a noisy session. But again, that strength in the Nasdaq is preventing any type of significant weakness from kicking in the overall market. All right, so I'll shift my focus now from big picture daily chart that we just talked through, where I said, hey, I'm going into next week, I think you have to lean cautiously bullish. Now we're going to shift our focus to the individual charts on the 195-minute, because those are the charts that I use for my actual entry and exit points. Actually, before I get to those charts, let's just talk briefly. I'm going to talk briefly about some trades that we have taken here this week. For those of you that are not aware, we have 3 different options signal services. Each one focuses in on a different style of trading and on different markets. We have our ETF Options Superstars program that utilizes a mix of different options strategies, long calls, long puts, debit spreads, and credit spreads, but we only trade the exchange traded funds, or the ETFs. That's all we focus on. We also have our Nasdaq Options Superstars program, which again uses a variety of different option strategies, but we only focus on the Nasdaq stocks. And there's a few Nasdaq related ETFs as well. And then finally, we have our Simplified Options Superstars program, which can trade any stock or ETF, regardless of the area that it's in, but we only trade long calls and long puts. Each one is very specialized in what it's looking for. Let's talk about the ETF program here first. We've had a really nice week on the ETF service. We have actually, go ahead and highlight here. We have actually closed out of 1, 2, 3, 4, 5, 6, 7 winning trades here this week. And bear with me here a second, guys. I've got to reply to a message here, so just give me a quick second. All right. Sorry about that. All right. So on the ETF service, we have closed out of these last 7 winning trades. And if you take a look at our middle column here, you can see that we used a variety of different strategies. We had some credit spreads in there. We had some long puts in there. We also had a couple of iron condors. The reason I wanted to point this out, it's just such a missing piece for so many traders right now. And it's really, it bothers me because I talk to a lot of traders that are just struggling to hit their profit goals. And when I dive in and take a look at what they're doing, a lot of times it's due to a couple of common mistakes being made. It's either trading too big, trading position sizes that are too large, or not using enough diversification, not using a wide enough variety of different option strategies. Buying long calls and long puts can work great in certain markets. Selling credit spreads can work great in certain markets. There's no perfect strategy that's going to work all the time. Using a mix of strategies is absolutely crucial. So when I took a look at XLB and EEM, these two right here, these were actually call credit spreads. When you sell a call credit spread, it's actually a neutral to bearish position. We ideally want the stocks to move lower, but they don't have to do so in a big way. I just need those stocks to stay below the strike price of the option that we're selling. In the case of XLB, I needed it to stay below 68. EEM, I needed it to stay below 45. As long as price action stayed below those levels, we got to make money. We also made money from time decay adding up and from volatility decreasing. In these markets where you get big movement but very little follow through, you can very easily see the time decay add up and really hurt any type of a long option position. With these credit spreads, now we're putting that time decay in our favor. We actually make money from every day that passes. We're looking to take advantage of that. EWZ and XLF. Those are two long put positions that we put on, and we closed those out for 38 and 31% returns on our capital. A little bit smaller returns. We normally like to see 100% targets reached on any type of a long option. We tempered our expectations this week because we've had very little follow through. We've had a lot of back and forth movement, but we really, in the grand scheme of things, we haven't gone anywhere this week. We just saw that over on the daily chart of SPY. What I am trying to do here is to take the profits, you take a look at 38% return, 31% return, and we're in and out in less than a week. I'll take that every week. Are they the big home run profits? No, but taking what the market's giving us, if this was a market where we were just seeing a large trending type move develop, that'd be a different story, but we're not getting that right now. Taking what the market's giving us. I'm not going to manage the trades just, being stubborn saying, hey, I've got to hit my 100% target. I'm going to take what the market's giving us, because as you can see, those smaller returns, the smaller profits can lead up to a big profit number. And I'll walk you through that in just a second. We also had a short call spread on the Dow ETF, symbol DIA. That was closed out for a 56% return on our capital. And then we had a couple of iron condors, which I'm going to circle back to in just a moment. It's what we call our overnight pop trade. It's a newer setup type that we're using. That it's an overnight trade. We're in and out in less than 24 hours. And it's just been producing some great returns for us. So we had a couple of winning iron condors for a 41% return on our capital and 25% return on our capital. And I'll talk about those trades in more detail. We'll take a look at the chart in just a moment. So all in all, if you're taking each trade with $500 of risk, that's the number that we like to use because it fits a lot of retail account sizes. If you've got an account size that's bigger than that, sure, you can ramp that up. You can risk $1,500, $2,500 per trade. Doesn't matter to us. It just depends on your account size. So if you take every trade with $500 of risk, it was just over $1,000 of profit this week. That's a really nice week. Because again, we didn't go anywhere, right? I mean, we saw some big moves intraday, but we didn't see a lot of follow through this week. We've just been stuck right on top of those support levels on SPY. But yet we were still able to book a really nice $1,000 profit this week. A lot of times people shy away from the ETFs because they think, hey, they're slower moving. You're not going to get the big profit potential. Yeah, they're not going to be as active as the Nasdaq stocks, but you can't argue with that type of a profit. I mean, that's phenomenal. We love that. Moving on over to the Nasdaq service, we have closed out of 6 winning trades here this week. And you can see those listed. Let me go ahead and highlight them here. So these are the trades that we closed out of on the Nasdaq service. Again, it was a mix of different trade types. We had a couple of call credit spreads in here on Starbucks and Uber. We had a long call position that we closed out of on Pinterest for a really nice 83% return. We also had those iron condors that we talked about over on the ETF service. And then finally, we had a short put spread on Lululemon, which we closed out for a 26% return on our capital. So on the Nasdaq service, we had 6 winning trades, just under $1,200 of profit if you're taking every trade with $500 of risk. Again, a really nice winning trade. I'm not going to say we're going to get through every week with all winning trades, right? I mean, it was a phenomenal week. We're going to have losers along the way, but when the market is volatile, it's an easier environment because now we can mix up our strategies. We can take what the market's giving us and not need those big bullish or bearish trends to develop to make money. That's why I love to be active with these types of strategies. And then finally, with our simplified option superstars, just 2 winning trades closed out here this week. We had a 90% winner on the real estate ETF, which is symbol IYR. And then we just closed out of a trade on XRT, which is a retail ETF. And that one gave us a 30% return. So all in all there, on the simplified option superstars program, we had 2 winning trades, $644 of profit. So it doesn't take a large account size. Again, risking $500 per trade to take these positions, and it just produced a really nice, profitable week for us. All right. Now, some of you might be saying, okay, those look great, but if I wasn't in those trades, what can I do for next week? How can I get active in these trades? Let me walk you through some things that we're looking at for next week. Let me actually bring you up the charts that we use to identify these setups. Let's start out with a chart of SPY. I switched over to the TradeStation platform, and I'm using the 195-minute chart. It gives us 2 candles a day instead of 1 candle. The daily chart is fine. I much prefer to trade the 195-minute, which is what we're looking at here. All right, so I mentioned over on SPY on the daily chart, we talked about leaning cautiously bullish next week. And here's another reason why that is. If we take a look at our red and yellow histogram down at the bottom, so what we call our pulse indicator, it tells us whether we're at an overbought or oversold extreme. When it starts to plot yellow like this, that indicates that we are between a 1 and a 2 standard deviation move on the downside. It does not mean that SPY can't continue to move lower. It just means it's not statistically probable. When you start to hit between a 1 and a 2 standard deviation move, oftentimes it'll lead to either a period of consolidation or even a reversal in the other direction. We talked here on the daily chart. We talked about how SPY this week, the S&P 500, has been choppy, right? We have been hovering right around those support levels. Not a surprise when you start to take a look at our pulse indicator, because it's plotting yellow, and it's done so for the last week and a half. We are oversold in the near term. Chances are we are going to get the period of consolidation that we're in, or even a break back to the upside. That's what I'm anticipating for next week. These yellow bars down here on the pulse, normally when I see that happen, if I see 3 out of the past 5 bars plot yellow, it has me interested, in this case, in selling a put spread. Selling a put spread would allow me to put on a neutral to bullish position. If I just buy long calls here, I only give myself one way of making money. It's just too aggressive. If I sell a put spread, I can lean bullish, but give myself 5 ways of making money. It's a more forgiving type trade. If I sell a put spread, I don't need a huge move higher. If we just sit right here into next week and don't do a single thing, I can make money. The only move that would hurt me if I sell a put spread is a big move lower, which I'm not expecting, because the pulse indicator is already telling us that we're at an oversold extreme. All right. So let's take that into account, and let's go back over to the Thinkorswim platform. But now let's go to the trade page and let's see if we can piece a trade together. So now we're looking at the trade page. And again, this can be done in any broker platform. It doesn't matter to us. We just use the Thinkorswim platform quite a bit. And we also use Tastyworks. Those are the 2 brokers that we use in our own trading. So now I've got a decision to make. I mentioned I want to look for a neutral to bullish trade. Ideally, I would love to sell a put spread. But what expiration cycle do I go with? I've got the October monthly options with 21 days left. If I go all the way out to November, there's 56 days left. Not really interested in going out to November, so it's just going out too far. With this type of a trade, because the market's been active, we could see a continuation move to the downside. But with this market so active, I would expect at least an attempt at a bounce early next week. So here's what I'm going to do. I'm going to take a look at what we call our overnight pop trade. In most cases, stocks and ETFs have options that expire. They expire monthly, the 3rd Friday of the month. A lot of cases, they have weekly options as well that expire every Friday. But SPY is one of those unique products that also has expiration cycles on Monday, Wednesday, and Friday. The overnight pop trade is a 24-hour trade. We're looking to open up the position here today and close it out first half of the day on Monday. And we're looking for very quick movement. Now, it can provide some really nice returns, but there's a few nuances here that you have to be aware of. If you're going to use a quick overnight trade, there is no potential to make an adjustment on a trade gone bad. If we don't get the directional move in our favor, come Monday, we're going to have to take the loss. There's no adjusting the trade on Monday because those options expire Monday afternoon. It's a more aggressive trade. In a lot of cases, if you use the monthlies, if the trade's gone bad and you're underwater, there's things that you can do to adjust that position. Not the case here. This is going to be a more aggressive trade. As a result, if you want to reduce your exposure a little bit, use this with a little bit smaller risk. A lot of times I encourage people, at least initially, to use 50% of their normal risk on a trade like this, just because it's more aggressive. So I'm going to open up the September 28th options. Those are the options that expire on Monday. The great part about SPY as well, if you take a look at the volume and open interest columns here, SPY is one of the most liquid products in the world on a daily basis. The liquidity makes it much easier for us to get in and out of trades quickly and at good pricing. So let's go to the put options on the right-hand side. I'm going to go to the out of the money puts, and I'm going to go to the 323 puts. They have roughly a 63% chance of closing out of the money. I am going to right click on the 323 puts, go to sell, and go to vertical. It's going to pop up an order down at the bottom where I am indeed selling the 323 put, and by default, it has me buying the 322 put, and that 322 put is there to define my risk, to hedge my risk in case I am wrong on the directional movement of SPY. I am actually going to click on the drop-down menu of the 322 put, and I'm going to switch that to the 321 put. I'm going to take a look at a $2 wide put spread here. This one is currently trading for 52 cents, $52 per spread. If I click on confirm and send here, excuse me, I am risking $148 to make 52. Not the greatest ratio at initial glance, right? Why would I do that? The reason I like this trade is it gives us 5 ways of making money on the position. I make money if SPY moves up, down, or sideways. I don't care, as long as price action stays above my break-even point, which is at 322.48. And that number right there is calculated by taking my short strike, my 323 put that I'm selling. We're going to subtract our 52-cent credit that we're collecting to put the trade on, and that gives us our break-even at 322.48. So now, if SPY drifts sideways, if we just drift higher, or even see a move to the downside, I am okay as long as price stays above 322.48. It's currently sitting at 325. So I've got about $2.50 where I can be wrong on the downside and still make money. The only move that hurts me is a big move lower. So I also make money from time decay adding up and from volatility decreasing, which it should if price action moves to the upside. That gives me those 5 ways of making money on the position. As a result, I am okay risking 2 or 3 to make 1. The high winning percentage is going to help the numbers work out in our favor over time. If we were risking 5 or 6 to make 1, no, that doesn't work. But because I'm risking 2 or 3 to make 1, now it works in our favor. I can get the numbers to work out in our favor over time. Now, here's what I like to do with these overnight pop trades. Everything that we just talked about is valid. This is a valid trade that could be taken. I don't like to take these pop trades until the last hour of the trading day. I like to come in between 3 and 4 Eastern time to place these trades. Here's why. Intraday, if you start to get into that midday session, the volume disappears. It disappears for a few hours, and it's more difficult to get fills on trades, not to mention you can get a lot of choppiness midday. Come end of the day, that last hour of the day, you get a feel for where the market's heading into the close. Are we going to see a move higher or lower? Not to mention the volume kicks back in and we see some of the best volume of the day during the last hour. So now I get to see what the market does all day long. I get to take advantage of the volume at the end of the day, and that's going to help me get filled at better pricing on these types of trades. So I bring that up. You could take this trade now. If you have a busy afternoon, that's fine. I don't have a problem with it, but I would rather wait until this afternoon, come back in during the last hour of the session and get this trade placed. Either adjust the strike prices. You can play around these strike prices a little bit depending on what the market does over the next few hours. Just make sure you can collect 50 cents or higher. If it's a $2 wide spread like we're looking at here now, just make sure you can collect at least 50 cents. So this is definitely one that's on my radar. I would like to get an overnight pop trade on going into Monday's session. So that's one that we'll be looking at here with our ETF students. Now, let's circle back to SPY because this is a trade that we took on yesterday afternoon. We sent this out to our students. we sold an iron condor. And I know the name is a little funky. I know it's intimidating initially for a lot of people. All an iron condor is we're selling an out of the money call spread and an out of the money put spread at the same time. It's creating what we're calling a profit window. I'm expecting the stock to stay inside of a range, and that range is defined by the options that I'm selling. I'm selling the 327 call and I'm selling the 319 put. As long as price stayed between those two numbers, we got to make money. Now, we were also buying the 329 call and buying the 317 put. We are buying those. They're the wings of the trade to define our risk. I don't want to take undefined risk right now. It's just way too risky in this market. I want to know what my worst case scenario is right up front. So we sold the iron condor yesterday for $64 per spread. It tied up $136 of capital to put the trade on. So we are right around risk 2 to make 1 on this trade. We ended up closing it out here this morning for 31 cents. Gave us a $33 profit, $132 profit following our risk parameters. Again, risking $500 per trade. That gave us a 25% return on our capital, and we had 5 ways of making money on the position. Look what happened overnight on SPY. What is it, a big move? Did we see a big move higher or lower? We didn't. Okay, we've seen the market kind of back and forth here today, but the beauty of an iron condor is it's a neutral trade. I make money from a stock staying sideways. How does that happen? How does it even make sense? Because I'm selling the spread to open up the trade, I make money as the options get cheaper. My goal is to buy the spread back and close it out for cheaper than what I open the trade for. These options get cheaper because we're so close to expiration. The time decay is extreme. These options are going to lose value very, very quickly if the stock isn't moving on expiration day. That's what we were banking on this morning, and that's what allowed us to close out of the trade. Even though we didn't get a big directional move, we were still able to close out of the position and book a really nice 25% return on our capital overnight. It's not going to be a home run profit potential. The goal here is to generate some really nice income. Do it a couple times a week. It's a great complement to some of our other longer term holdings. Why did I come up with this trade? Why did I, start using this with our students? Because what I'm looking to do is to get as many areas of diversification as possible, as much exposure to different trade types, to different markets as possible. That's what's going to give us more consistency. If I go back, even 5 or 6 years, it was entirely possible to trade the same 2 or 3 stocks every day and just buy long calls and long puts. And you can make really nice profit that way. Markets have changed, and the diversification makes a huge difference. And these are the overnight pop trades that have continued to help our returns personally. So yesterday, it was an iron condor. The trade that we just took a look at here a few moments ago, that short put spread, that's one that we're looking at for Monday. We would open it here today and then close it out first half of the day on Monday. Jake stating, first time here. Well, welcome, Jake. Thanks for joining us here today. Do you still trade DAX on Renko? If so, what brick size? So Jake, I don't personally trade the futures markets. I used to a number of years ago. I'm strictly focused on the options markets at this point in time. So I'm not going to be the best resource to help with any futures related questions, as I'm just not active in those markets. We would be more than willing to help with that, though. If you want to send an email to info@netpicks.com, we'd definitely have one of our futures traders get back with you and give you some additional information on the DAX, on the Renko brick size, and so forth. So send us an email. More than willing to help out there. And we can certainly try to get one of our futures traders on one of our Friday sessions here going forward to help with some of those questions. Brian asking, hi, Mike, do these pop trades put you in risk of pattern day trading? So great question, Brian. No, they don't. So what Brian is referring to there is if you have an account size, a brokerage account size less than $25,000 and you're trading options, you're limited to 3-day trades in a 5-day stretch. Once you hit 3-day trades, they cut you off from initiating new trades. All right. A day trade is classified as opening and closing a trade the same session, that same day. With these overnight pop trades, we're opening in the afternoon and we're closing them out the following morning. So that is not classified as a day trade. Those are two completely different trading sessions. Now, while we're on that topic, please note that the pattern day trading rules are only applied to a margin account. If you want to day trade options, you can do so within a smaller account size, but you just have to do so in a cash account. A cash account is not subject to the pattern day trading rules. All right. So if you guys have any other questions, keep those coming in. I'm be more than willing to help there. All right, let's take a look at some of the other markets that are intriguing going into next week. Let's talk through QQQ, the Nasdaq ETF. Definitely oversold here in the near term as well. And when I say oversold, guys, I'm not saying the bottom is in and we're going to head higher for the next few months. What I am saying going into next week is the first half of the week, first couple of days, I could certainly see a bounce higher. I'm leaning cautiously bullish on the Nasdaq as well. The Nasdaq's been super strong here today, and it's hard to fight that bullish trend that has been in place on the Nasdaq. We've seen very little sustained weakness on the tech sector. So I'd be open to selling a put spread, just like we talked about over on SPY. I'd be open to doing a very similar type approach on QQQ as well. Go out, sell an out of the money put spread, looking for the market to either consolidate here or bounce higher. Definitely something that I'm looking at going into next week. Now, some of the individual sectors, let's take a look at XLF. This is the financial ETF. The financials have definitely been beat up. XLF is off of the lows today. You can see this candle on the right-hand side, starting to see it perk up a little bit. That is of interest to me because if this market is going to indeed bounce, again, like we said earlier, we need the financials to participate. If they're going to come to life a little bit, they could certainly take that baton, take the leadership, and give us that catalyst for a move higher. Not to mention over on the pulse indicator down at the bottom, you zoom in here a little bit. The pulse indicator is also plotting yellow. Like we mentioned earlier, that indicates that we are between a 1 and a 2 standard deviation move on the downside. We're oversold. That could certainly lead to at least an attempt at these financial names bouncing higher into next week. Be cautious with any new trades that you put on the financials because you do have earnings upcoming that second week in October. So just be cautious there. The other indicator down at the bottom is what we call our trend strength indicator. That's that blue and the red histogram. You can see that the trend strength indicator is firmly red, indicating that bearish momentum has been in place and is still in place. The trend strength indicator is there for me to help identify the long call and long put opportunities. Because it's still red here, we're still in bearish mode here. I'm not interested in buying long puts because the market is already in an established move lower. I'm also not interested in buying long calls here. In order for that to be a valid setup, I need this trend strength indicator to pop up above the 0 line. It has to go back blue. We're not there yet. I'm open to using a credit spread because now I have 5 ways of making money on the trade. The timing of those trades does not need to be perfect. When you buy a long call or long put, the timing is crucial. So with the pulse indicator reading, like we talked about earlier, that gives me the ability to sell a put spread and lean a little bit bullish, even though the trend strength indicator has not confirmed that price is breaking to the upside yet. All right, so definitely interested in XLF. If we take a look at some of the individual financial names, the one that is most overdone is Citigroup. And you can see on the Citigroup chart, I mean, it's definitely gotten beat up, no doubt about it. And what's interesting here is that the pulse indicator went from red to yellow and now to green. That green pulse reading, that indicates that price is between a 2 and a 3 standard deviation move on the downside. Less than 2% of all occurrences are going to fall outside of this range on the downside. That means it's not statistically probable for Citigroup to continue selling off at the pace that it has. Out of this pattern, you will typically see price action stabilize or even reverse to the upside. Now, the trend strength histogram is firmly red. We're still in bearish mode, so I'm not interested in buying a long call here on Citigroup, but I would be interested in selling a put spread. Selling a put spread would allow me to lean a little bit bullish with a more forgiving trade, a trade that would give me 5 ways of making money. So Citigroup is definitely on my radar. I get questions from people that are starting to use the whole standard deviation approach. And when you get the yellow and green bars, is that enough to just jump into a trade right then and there? On the yellow bars, I need at least 3 out of the past 5 bars plotting yellow. If we start to see green bars, all I need there is 1 or 2 green bars. That's all I need. One filter that you can use, and I have a lot of people using this, is use the 8-period exponential moving average. It's that red and blue line. So it's this red line right here. What you can do there is hold off on initiating a trade on Citigroup. Don't sell a put spread here until price action breaks up above the 8 EMA. And that filter works really, really nice. You're just essentially waiting for price action to confirm that it has indeed found a bottom and that we're indeed ready to bounce. So I have done both. I've used that filter at times, and there's times where, in this case, with it so oversold, I'd be willing to sell a put spread right now. A lot of times what I will do is if I have yellow bars here, that's when I'd be more interested in using the filter with the 8-period exponential moving average. If we have the green bars, that indicates an even stronger extreme. In that case, I really don't need to wait for price to turn. I'd be willing to just sell the put spread right there. And that's where we're at on Citigroup. So Citigroup, definitely another one that we could look at. If you have not looked at the financials here this week, if we jump in and take a look at Citigroup, this is not a trade that I'm looking at for an overnight pop. This one, I'm going to go out a little bit further. I'm going to go out to the October monthly options, the ones with 21 days left to expiration. I'm still going to take a look at the puts. I'm going to go to the out of the money put options on the right-hand side. And let's go ahead and take a look at selling the 40 put. I'm going to right click on that 40 put, go to sell and go to vertical. It's going to pop up an order down at the bottom where I'm selling the 40 put and then buying the 38 put at the same time. Right? Very similar trade setup to what we talked about on SPY earlier. It's a $2 wide put spread. There's a $2 difference between the strike prices of the options that we're using here. I want to collect at least 50 cents. Well, if I take a look at the price, it's only at 47 cents. The problem is if I can't collect 50 cents here, if I click on confirm and send, now all of a sudden I'm risking greater than 3 to make 1. I want that reward to risk ratio. I want it in that risk 2 or 3 to make 1 range. So I just can't collect enough premium there. It's close, but it's just not enough. Doesn't mean I have to walk away from the trade. It just means let's go ahead and take a look at making an adjustment to this trade. So to collect more premium on a setup like this, we are going to adjust the strikes. And to adjust the strikes, I would have to move the strike prices higher. I'd have to move them up to 41 and 39. So I'm selling the 41 put and buying the 39 put at the same time. Now I can collect 64 cents. If I click on confirm and send, now I'm risking 2 to make 1. I'm risking $136 to make 64. That is much more doable. I like that setup a lot better. My break-even point would be at 40.36. It would give me about $1.50 of cushion there. I'm not in trouble on this trade until Citigroup moves below 40.36, which I'm not expecting because it's already oversold. Remember, it's between a 2 and a 3 standard deviation move on the downside. So I make money if Citigroup moves up, down, or sideways as long as it stays above 40.36. I also make money from time decay adding up and from volatility decreasing. So there's 5 ways of making money on the position. So that's another one that I'm looking at going into next week. Definitely a valid trade. You could place it now, or like we talked about earlier, you could wait for that last hour of the session for that volume to kick back in. Either way, doesn't matter to me. For me personally, I'm going to be waiting for the last hour. All right, so that is Citigroup. All right, let's take a look at Stitch Fix next. This is symbol SFIX, and let's go ahead and pop up that chart. The reason I wanted to pull this one up because, we've taken a look at a lot of credit spreads today, and I know some of you are maybe newer to that whole concept. Some people just, for whatever reason, I don't understand it, but for whatever reason, some people just don't want to use the credit spreads. They're missing out on a huge opportunity, but obviously we can't force anybody to use that type of a strategy. So if you're just focused on long calls, long puts, let's take a look at a potential trade here going into next week. This is the same 195-minute chart, but now take a look at the trend strength indicator down at the bottom. It just flipped from blue to red. It flipped from bullish momentum to bearish momentum. Price action also closed below our moving averages up top. That gave us a short trade. That gave us an entry point on Stitch Fix right here at 25.64. It actually triggered in early this week, but we're still hovering right around that level. This is a valid bearish trade. Okay, so if I wanted to put on a trade on Stitch Fix, let's go over to the trade page. With the long options, if it's not a credit spread, if you're trying to buy an option, I tend to look at options that have between 20 and 60 days left to expiration. Normally the range that I'm in. If you're going to be closer to 20 days, it's a more aggressive trade. The time decay is more significant with those shorter duration options. It's a higher risk, higher reward type of a trade. If you start to go farther out in time, if you go out to November with 56 days left, it's a more conservative trade. Even though it's going to tie up more capital initially, those options are going to react slower to changes in stock price, and the time decay is not as big of an issue. So it really depends on how aggressive you want to be on the trade. How quickly do you expect Stitch Fix to move? In this market right now, with a lot of big moves happening, I would be okay continuing to trade the October options into next week. So let's open those up, the ones with 21 days left. And let's go to the put side, and let's take a look at some put options that are slightly in the money. I'm going to take a look at the 27 puts. Why did I go to the 27 puts? For a couple of reasons. Number one, the delta of that put option is minus 0.59. Ideally, I like to see the delta of the options that I'm buying between 0.6 and 0.65. We're right there with the 27 puts. That typically gets me 1 to 2 strikes in the money. Also, look at the volume and open interest, specifically the open interest column here. There's 1,200 contracts of open interest. The higher the open interest, the more active those options tend to be. Makes it easier to get fills on trades, easier to get in and out of those trades quickly and at good pricing. Right? So definitely, I mean, if you take a look at the options around that 27 put, and you can see the 27.5 put, only 47 contracts of open interest. The 26.5 put, only 56 contracts of open interest. So there's definitely the best activity there in the 27 puts. And they're trading right now for right around $2.37, $237 per contract. So pretty reasonable. They're not overly expensive like some of the other tech stocks. So that is another valid trade going into next week. It is a bearish position. You only have one way of making money. The stock has to move to the downside, and it has to do so relatively quickly. That's the only way you can make money. So it's not a bad trade. It's just a more aggressive trade. So with any type of a position right now, keep that risk small. We recommend risking between 2 and 5% of your account per trade. You start to get over that, and it just you're more exposed to larger drawdowns. So just keep that in mind. Right. So that is a long put position on Stitch Fix. One final chart that I want to take a look at is Dollar Tree, symbol DLTR. This is another one that's on my radar for next week. If you take a look at Dollar Tree, you can see that we did have a whole slew of yellow bars on our pulse indicator. We also had one green bar there as well. So we were oversold. Price action has bounced the last few days, right? Again, if I see those yellow and green bars on the pulse, it indicates a potential opportunity for either a sideways consolidation or a bounce higher. It has me looking at selling a put spread. We also mentioned that filter, looking for price action to close above the 8 EMA before you did anything. Notice how price action has also, the last couple of days, we have seen price action close above that 8 EMA. So this is definitely another short put spread opportunity. Just like we talked about on SPY and Citigroup, this is another opportunity here where price action has confirmed that a bottom is in the near term. Definitely another opportunity there for either this afternoon or early next week. So there's potentially 4 trades going into early next week that you look at. SPY, Citigroup, Dollar Tree, and Stitch Fix. So we gave you a couple of opportunities there for trades that we're looking at going into next week. If you have any other questions on anything that I have covered today or anything that I've not covered, let me know. Let me also put up a link on the screen here. The link that I have up, so it's netpicks.com/0920 EOS. No, it's a little bit of a mouthful there. If you go to that link, there is a webinar there that you can review over the weekend that talks about our ETF Options Superstars program in more detail. A lot of what we talked about today, we apply every single week in our own personal trading, along with our students, with our customers, and we send out between 3 and 5 trade recommendations each week. We let you know the exact details of the trades that we're taking. We let you know when we're opening a trade. We also circle back and send you an alert when we're closing out of a trade. That way you're always in the loop from start to finish on every position. And we utilize the ETFs to our advantage with that service. So that video, that link there up on the screen, that video will show you how the service works. We'll cover pricing, how the alerts are delivered and so forth. But again, that service did wonderfully well here this week. 7 winners, no losing trades. So really nice results. And if you're interested in adding this style of trading to your toolbox, we'd love to help you out. So take a look at that link. If you have any questions, as always, feel free to contact me directly. My email is mike@netpicks.com, or you can leave a comment on the video here as well, and we'll certainly get in touch to help out. All right. So I am going to start wrapping up for the day. Enjoy your weekend, everybody. We will be back next week. We'll do another couple of sessions next week. So stay tuned. We'll definitely be in touch early next week with our next video. So enjoy your weekend, everybody, and we'll talk to you guys early next week.